Hey everyone, welcome to another episode of the Everyday Real Estate Investor. I am excited because we have our lender and friend Grant Schroeder here again today. I think it was end of January that we had our last update, and things are just moving so quickly. Maybe, no offense, I love having you on the show, but maybe we'll get to a point where it's not quite so crazy out there that we only have to have you on a recorder or something like that instead of like every month just to get an update on what's going on. But glad to have you here. We're going to talk a little bit about the market in general and of course the lending market, and just get an update on what's going on and talk about kind of the craziness that's been going on.
Yeah, thank you for having me, Ben. Always enjoy these conversations.
Yeah, awesome. Well, let's talk about mortgage, the mortgage world, right? What's going on in interest rates? What's going on with the Fed? What are they thinking? What crystal ball? Where are we going? All of that stuff.
Where do we start? I mean, we recorded end of January, and then the chaos ensued throughout February. I mean, we touched the top of the fives, mortgage rate wise, low sixes, end of January, and we shot up about almost a whole % over the course of February. Some of the inflation prints, the job numbers came out hotter, stronger than expected.
Yeah, those darn good job reports, man. Yeah.
The thing that's crazy with the job reports is some of the statistical and the seasonal adjustments made. Like, it's not even actual job creations, but there's a lot of data manipulation that makes it look like the job market is stronger than what it is. And like I've been saying to a lot of people, I think we talked about this with buying now and refinancing 12 to 18 months down the road. Many projections from people were coming out saying, we'll get down to the fives consistently a lot sooner. But inflation is not going to come down. The rate of inflation is not going to come down in a straight line. Although we want it to, mortgage rates are going to most closely follow the rate of inflation moving lower, and it's going to be a little bit of a ride through the course of this year. We will see mortgage rates move lower over the course of 2023. We're most likely going to see more meaningful improvement and sustained improvement in mortgage rates come May. There'll be an inflation report with CPI coming out that a lot of times shelter inflation is lagging, so it peaked just a month or two ago. So it's holding the inflation values up higher, where that is going to see a pretty large drop-off come May. So that will certainly help.
There's a lot to unpack there. So I think when we did our show in January, rates had come down more quickly than we thought, right? And so we're like, this is going to be, all these projections. And we mentioned, I think Neil Bawa and his projections about being, and I think you had even mentioned like 12 to 18 months time frame to get back down to like mid, and we're like, man, we're already here. This is awesome. And then that quickly changed the other direction. The other interesting thing is about, so, with the jobs reports, you mentioned the seasonal aspect and some of the adjustments that they make. Okay, they're probably smarter than me, maybe, but I question the Fed on some of these things, and I feel like they overcorrect on a lot of things. They waited too long to do these changes with interest rates. We had mortgage rates way too low for way too long, and so we let inflation get beyond to where now they have to overcompensate. They'll probably overcorrect, and maybe they already are, but everything lags in the economy, right? And so I feel like jobs is the same thing, where it's like, jobs, so we got to do all these things to make job loss, which is, again, like, we want job loss because then that's good because people lost jobs, so the economy is not as good, and so inflation's going to slow down. Like, it just is like unfortunate that that's how that all works out. But it's like, okay, so the jobs reports come out, but then there's a lot of talk of layoffs, and there's a lot of people that have, there's a lot of big companies that have offered compensation packages for leave, and those aren't on the current jobs report numbers. There's a lag, but they're coming. Right? And so it's like, we need to make further adjustments because the job losses aren't there. But they are there. They're in the pipeline. They just haven't hit yet. So I wonder how much, and I'm not an economist, but I just wonder how much of that will come into, or maybe 3 or 4 months down the road, we're seeing more job loss than what they were targeting, because you would think they would account for that stuff. But
I mean, there's a household survey component, and then there's a business survey component. And one had seasonal adjustments in it. There was some statistical modeling that took place, and I listened to many different things where it talked about really we were almost net zero. Like it showed a big positive, like 570,000 job creation,
yeah, it was a huge number.
But we were very close to net zero, if not job losses. I mean, and going back to what you were saying about the Federal Reserve, as Logan Motashami on Housing Wire likes to say, the Federal Reserve is old and slow. They tend to react too late, and they tend to overdo it when they do react. And so many of the they started hiking rates in May. Mm-hmm. We've seen some significant three-quarters of a percent hikes, multiple back-to-back months, and we are still just starting to feel the effects of the May hike when it first started. Like typically those have a 6 to 12 month lag, and unfortunately the Federal Reserve is looking at the here and now, and they zoom in on that where they're still like they're going to keep raising rates. And it's like until something breaks, okay?
Right. Until the inflation numbers are where they want them to be, but then by that point, to your point, I mean everything lags, right? So it's like, okay, if we're seeing the inflation numbers and the jobs numbers that we want to see, what does the next 6 to 9 months look like after that? Yeah. In theory, it should be continuing to get worse. Mm-hmm. I mean, I guess worse as far as the economy, better as far as inflation continuing to trend down. But I mean, there's a lot of talk of economic recession and all of that, and I think that's very real possibility, especially with it may not seem terribly bad now, although there's some indications of that it's not great either, right?
Yeah,
but
different
but the leg there,
cracks,
okay, we're in a good spot now. Well, okay, but all these adjustments that you made are going to continue to have a ripple effect in the economy for another year or whatever. So that's what you have when you're pulling levers, right? And the economy is you try to pull one lever and and it just again it has a ripple effect that lasts longer than what. And a lot of people don't understand that, right? The economy doesn't react instantly when things, for the most part. Now, if you pump a ton of money into the system, it sure can happen quickly. But in general, there's a pretty good lag to policy, to monetary changes, all of that stuff. So, which leads to another. You mentioned the changes in rates, up and down and up and down. That's, I think, so traditionally real estate is pretty stable. Now you could argue the last few years it hasn't been that way to, I guess a positive if you own real estate, a detriment if you were trying to buy real estate. But it has seen a ton of positive growth, right? I think we're going to see a lot more volatility than what we're used to in the real estate market, probably moving forward. I mean, we see rate hikes and interest rates. If we see interest rates go up, then we see pullback in buyer activity. We see it. A year ago, if we said rates at 6%, buyers would have just been like, well, they disappeared for a while, right? And in the summer, it was like hot buying season, and rates were 5.5%, 6%, and it was like, where are the buyers? Now it's like rates come down to 6%. And all the buyers start coming back out because now we kind of reset our expectations. 4 months after they were 3%, 3.5%, it's kind of tough to swallow a 6% interest rate. But now we've been there for a while, and so it's like, okay, people are understanding this is where the market's going to be for a while. They still need to buy a house or want to buy a house. Inventory is still very low, so I think we're going to have those runs on the market that are kind of week by week, where depending on what interest rates are doing. Ironically, what you probably should be doing is buying counter trend, right? Rates go up a little bit. That's when you get out and do some shopping. Maybe you do something with your loan, do some sort of float down or something like that. You can talk to that more than I could, but where you kind of keep your options open for a lower rate. If it changes to your benefit, or you just do a buy down or something, some sort of combination. So I guess I'll let you to speak to that. But so someone that's maybe like, okay, when buyers kind of pull back a little bit, I see that's my opportunity because rates have maybe ticked up a little bit, like they basically we'll talk about the latest news, right? Here in a minute, but strategically, how can a buyer take advantage of those, like this kind of volatile week by week activity and what they're doing with their loan options?
Yeah, and to your point, I mean, we saw interest rates kind of peak back in October around the mid sevens, and people got used to the new normal of being mid to low sixes. In January, we touched the top of the fives there, and we saw an influx January, February in terms of applications and interest. It was like pre-spring buying season, and now we're still seeing a lot of activity, but there's been a little bit of a pullback when you see rates climb 1% over February. I mean, a lot of our clients right now that are still taking action, still finding wins with sellers, getting seller credit for a 2-1 buy down. Like if the par rate is at 6.75% and they're doing a 2-1 buy down, okay, their initial payment for the first 12 months is going to be at a 4.75%. And that can all be paid for by the seller. We've been utilizing that a lot more as we've seen rates move higher in February. I mean, really early on in February, we didn't know how high they were going to climb. And at the end of the day, it is hard to be a buyer not knowing what your payment could potentially be. That volatility in reality is not good for the market. Even if we settled in the mid sixes or high, if we just stayed there consistently for a month or two, that would certainly help bring stability in some sense to the market, where buyers know what to expect.
I completely agree. I think that's the piece that is the kind of wild card in this market is we're seeking stability, and unfortunately the market isn't being allowed to seek stability. It's we got lots of levers being pulled and things like that. But that's really what we need is stability. It's knowing what to expect, both on the buyer and the seller side, right? Just not knowing week by week, what day by day or hour by hour, what you're it's like even checking, you check stock prices. It feels like that's what you're doing
with mortgage
day trading your mortgage rates, right? Like it's crazy. So
mortgage-backed securities market, where interest rates are based, and has been just this last week following the SVB news, the Federal Reserve stepping in and securing deposits, like ensuring people who were over the FDIC limit, because 95% of the depositors in that bank were businesses with more than the $250,000 that's guaranteed by the FDIC. Taking emergency measures for that, and the market has not, it took the whole week trying to digest, and it's still trying to figure out. You had Fed comments today, trying to figure out where things are going. Secondary investors there's just so much uncertainty. You see rates, we get a rate sheets in the middle of in the morning, but throughout the day we're seeing changes throughout, just because in a normal day you don't see that much volatility, but it's just right now it's just been crazy lately.
Yeah, man, I shouldn't comment on the bank failure aspects, but it is interesting. That's totally, maybe not totally, because it's all connected, right? But it's an interesting precedent that it sends that this is obviously outside of real estate and mortgage rates, but it's just an interesting thing to think about with our government and our economic system, where they're saying something's government guaranteed up to a certain amount, and then look, it's actually maybe it's actually guaranteed more than that. So now you've made a decision that okay, how does that affect things moving forward, and how banks are able to maybe be a little bit looser with what they can do. I mean, obviously they have regulations they still have to follow, but it's like, well, I don't know. It's like telling your kid to not do something, and then they do it, and you're like, no big deal. We'll just, whatever, we'll let it slide. Well, okay, what are they going to do next time, right? It's like, you just, okay, well, it's only insured up to this amount, but, we're going to bail you out anyway, right? Okay. And I get it. I get why they needed to do it, quote unquote, right? I mean,
it was more for the overall economy, not wanting other bank runs to occur.
Absolutely.
Showing that there's stability, and it was...
But is there a reason?
An isolated incident to the bank's poor money management, not having a risk manager for the last 6 months. Like SVB, Signature. I mean, First Republic had issues. They had to get bailed out at the discount window from some of the big players.
Yeah.
I mean, right now, from what we can see, it is isolated, but it is going to be very... There's not a definitive answer on
it is an interesting,
what that's going to play out.
Yeah. I just think it's an interesting message.
Because it does affect mortgage rates.
Yeah.
It does affect the mortgage-backed security. So many credit unions and banks are lending on their deposits. I mean, they take in $100, they keep 10 on, and they lend out. They're lending to 9 to 1, 10 to 1. A lot of the times, they only have to keep 10% of what their deposits are, and they can lend out the rest. And that's where SVB got in trouble. A lot of lenders are lending based on the mortgage-backed securities market, but in general, bad news in the economy is good news for mortgage rates.
Right.
That's why we say a lot of times when an economy heads into recession, you see improvement in mortgage rates. And right now, the market is still trying to understand what that looks like in banking. Okay, is it bad news, good news? The Fed jumped in so quickly to save the day. Okay, what's the precedent that's setting, and are there others out there?
Yeah, absolutely. Yep. That's I just wonder down the road how that's gonna potentially play out in other, because if you do it for one, okay, it's like case law, right? Almost.
There's been some commentary from Janet Yellen. It's like it's not a done deal that every bank is insured, because there was like a small regional bank in Oklahoma that was having issues with their deposits, and the Federal Reserve has not chosen to step in and cover those deposits over the 250.
They do have favorites, don't they?
That is kind of the tendency we're seeing. It's like, I don't know if it has to do with size or if you're on their favorites list. It's kind of pick and choose.
It's probably both. How much is it going to affect the economy as a whole?
What are the ripple effects?
What are the ripple effects? If GM was in trouble, would they bail them out versus Elon Musk? Okay, I'm just saying. They absolutely have their people that they in their companies that they favor and the ones that they don't. So and again, a big part of it is the ripple in the economy. So, So we talked a little bit about the volatility. What have we seen over the last couple days here, and then how is that going to play out as we, again, crystal ball time? How's that going to play out over the next? We're heading into the spring market, and we'll touch on inventory and things like that because that's going to play into it as well. Obviously, so the numbers that I have are local here to the Portland metro area, but there's a lot of markets that I think reflect similar trends. Yep. But yeah, if you're not in the Portland metro market, always make sure you're checking your local data, because everything we talk about on here, for the most part, is national, and policy and monetary system. All that affects things to some degree on a national level, for sure. But every market reacts differently, and so you just have to remember that when you're taking in this or any other podcast, any other piece of information, that just because something's happening on a national level doesn't mean every market's going to react the same and grow at the same level. It just doesn't work that way, right? You have to look at all of your local drivers and what's your in net migration, and what does the local economy look like? What does the inventory there look like? All of, affordability, all of that stuff comes into play. So you can't take national stuff or national housing numbers, national inventory levels. All of that is it's good to look at, but you certainly can't make a local investment decision based on that.
I mean, you have markets that, across the nation, you're seeing 5 to 15% correction, and around 10% on average across the nation. But you have markets in Florida and the Northeast that are positive year over year last year,
which we saw. I'm gonna just because I think that segues into this. So we saw that last year, right? We saw, I think, from May through the end of the year. We peaked in May basically, and then through the end of the year, we saw between a 10 and 12% decline in prices. Mm-hmm. That's fairly significant, right? But I would still classify that as a correction, right? It's absolutely, that's not a crash. That's a correction in pricing. Mm-hmm. We didn't drop 30 to 40 to 50% like we did in the financial crisis. So certainly a correction. Mm-hmm. Very much affordability and interest rate driven. Yeah. But then you look at the numbers for February for the Portland metro area here, and we saw it was I'm going to use my cheat sheet here. Median sales price 4.8%, up 4.8% compared to January. So in 1 month, we saw almost 5% increase in median sales price. So about half, 40% of the drop that we saw over the last 8 months, we got back in 1 month. So where does that lead to from here? I don't know. And inventory is back down under 2 months.
Yep.
The big component now moving forward is inventory is low, demand's obviously there. Prices are trending back up heading into spring again. Very early. I mean, traditionally markets start to trend up March, April, May, you start to see that upswing. We're seeing it very early, right? And so the big factor is now interest rates. So tell us what's going to happen in interest rates.
I mean, interest rates are going to have an effect, like we saw the last 6 months of 2022. But I mean, by and large, the driving factor throughout this year is going to be supply and demand. I mean, we're seeing it here locally in Portland. We're seeing it in like Phoenix, Arizona, Maricopa County. Like they got over 4 months supply. They're now down to like 2.5, 2.7.
And 4 months is not an oversupply. That's
still
that's like lowish end of a stable market.
It's high for what we've been at since 2019, 2018. But now we're trending right back down. The demand is there. People are adjusting to interest rates and the payment. We will see mortgage rates move lower over the course of 23, like I was saying earlier. It's just a matter of we don't know how quickly.
Yeah.
There's a lot of factors at play, from the Federal Reserve to what international central banks are doing, ECB, what's going on with China, Taiwan, Russia, Ukraine. There's a lot of different factors in how globally connected our economies are that could affect that. I think by and large, we are seeing inflation. The rate of inflation has peaked, and that is slowly starting to come down. How quick it moves lower will largely determine how quickly mortgage rates improve over the course of this year.
Yep. Yeah, and I think that's obviously going to be a factor in how much price growth we see.
Yeah.
I think we will see continued appreciation. I think the fact that we gained almost 5% from January to February, I think that proves that theory, and that we'll continue to see that moving forward. But I think interest rates will obviously have potentially a downward pressure on that just because of affordability. So I posted a video on one of my social media channels. I don't quote Dave Ramsey a lot, okay, but he posted a video, and it was doing a response to it that he basically was saying the housing market, the prices aren't going to come. Now I don't know when he posted this because obviously the prices have come down. But in general, his statement was prices aren't going to come down in real estate because we have a supply-demand issue, and that's the basis of all pricing. Now, my caveat to that always, and if you listen to any of my comments about that for the past however many years, is always it's the capacity to pay, right? So you can have all of the demand you want and no supply, but if some people don't have the ability to pay, whether that's affordability or the availability of funds, it doesn't matter.
Yeah.
So if rates get too high or if lending guidelines get too strict, then that will constrain growth, regardless of how much supply-demand imbalance there is, to some degree. So, and that's how you see more volatility, is when you have all these different factors pulling on each other. And so when one thing adjusts a little bit, then it's like the squish factor, right? So you adjust it here and it squeezes out there. And you have that when you have all of these factors kind of imbalanced, that's when you see more volatility there.
Yeah.
So I still feel great about real estate long term. What are you advising? You work with a lot of investors. What are you advising your investor buyers to do right now on the lending side?
A lot of investors, house hackers, is still a good time to buy. They're taking action right now. It is getting harder. Like, had seen clients in Vancouver, Washington, Portland Metro, in Idaho, in Arizona. We're starting to see bidding wars again. We're starting to see 3, 4, 5 offers sooner than I thought. I thought, okay, come Q2, to get into April, May, traditional spring buying season, regardless of, okay, as long as rates
2
aren't
months
up
of
and
inventory. And,
as long as rates aren't crazy high, like they're six to low sevens, and I mean, never thought we'd get to fives in January, but we did. But we're bouncing right back up.
Yeah.
We're seeing that it's getting harder to get seller credit and be one-on-one with a seller like you have the last 6 to 9 months. There's still opportunities out there. We're seeing some of the cream of the crop houses that come to market are selling over a weekend.
Yeah.
With like one in Vancouver this weekend that had 7 offers on it. Our client got outbid significantly on it, but we are starting to see that competition again. So it's getting harder, but there are still opportunities to be creative, to buy a house. Like we had a client in Newburgh that, okay, a little bit higher price point, rates are higher in February, but then get creative, rent out rooms, offset the mortgage. Like there are multiple ways to win with house hacking and offsetting your housing expense.
Yep, great strategy. And I always, whenever I talk to especially first-time home buyers, if there's any sort of mention of, or even if there's not, of any sort of mention of, I'd love to get into real estate investing at some point, or I mean, generally that's when it comes up, but I'll even bring it up sometimes if it's, just because I think it's a great option, right? Hey, would you consider buying a duplex or buying a single family home with an ADU? I mean, and a lot of times, absolutely, right? And so, because you're offsetting your mortgage payment, you're going to be paying less than you would be just buying, the price point on a duplex isn't that much higher than a single family home. So, your mortgage payment is not that much higher. And then you've got rent coming in that's going to offset it significantly. So it's a great way to go from maybe not even being able to afford something, because you can use those rents to offset, right? So you can increase your approval based on that income and be able to afford. Maybe you can't afford a single family home, but you can afford something with a second unit, right? The other interesting thing that we talked about, I don't know how deep you want to get into this, but some of the nuances of lending that are changing in certain sectors of the market. I don't know, we'll try to keep it non-political, but certain sectors of the market that are getting maybe a little bit more incentivized versus other sectors that are maybe being a little bit more disincentivized with the loans, just in the form of fees and things like that. So as much as you want to speak on that just a little bit, just so we know what you're seeing out there, because it may be an opportunity for somebody as well, right? So a lot of this is back end on the lending side. I mean, a lot of people saw the announcement. FHA mortgage insurance got reduced from 0.85% to 0.55%, which is part of the people's monthly payment, which certainly helps a little bit with affordability. We've seen changes. Most clients. Most realtors will never hear the term LLPA or loan level pricing adjustment. Those are things on the back end of our rate sheets that Fannie, Freddie, HUD with FHA loans, they kind of dictate pricing that comes through and affects those. I guess kind of a 30,000 foot view. And they made some adjustments kind of based on credit score, based on debt to income ratio, trying to incentivize people that maybe have a little bit lower credit score with maybe a slightly better rate or a little bit less cost, instead of like a blanket approach, which is typical, versus those, who have a little bit better score that might not see that same benefit. Someone with a 720, 740 score. And it's not a huge difference, but it is a slight tweak on the back end of things that we see from Fannie Freddie that's announced. Most clients won't see much of a difference, lender to lender, on the front end, but that is something we're seeing current administration trying to encourage home buying for lower income or lower middle class folks to still achieve that dream of home ownership. Yep, there you go, and we'll leave it at that. I mean, a lot of times that you can get political on any of this stuff. The reality is, it doesn't. It maybe it matters, but it really doesn't matter in the sense that, like, it's happening and you can't do anything about it. So if you know it's happening, and this is maybe not an investment standpoint thing, although maybe if you're flipping a house and like this sector of the market's getting a little bit more of a bump in incentives than this one, then maybe it does come into play, right, as an investor. But the key is to know what's going on. Now, you may not agree with what's going on, but if you know what's going on, you can position yourself to take advantage of that, or at least not have it hurt you, right? So
Yeah.
the key is to know what's going on. Again, you may not agree with it, but it doesn't matter in the sense that you need to just take that and adjust to it as an investor. So
that's why it's wise to have a good real estate professional in your corner, a good realtor, a good lender who also understand investing. I mean, not only are we seeing market volatility from a rate standpoint or uncertainty in housing, but guidelines on the lending side are changing constantly. Like I think between our last recording in January and now we're recording on March 22nd, we saw the seasoning period for cash out refinances, people who are utilizing the BRRRR method, buy, rehab, rent, refinance, repeat, go from 6 months starting here April 1st to 12 months. So someone buys with a hard money loan, renovates a property, they can't pull cash out at the after repair value until 12 months now.
Yeah,
those types of guidelines.
You can rate in term. You can still rate in term, but you can't
to pay off the hard.
Yeah,
you can only get out what you put into the property.
Yep.
That things like that. I mean, as the economy shifts, we might continue to see like a little bit of a tightening in debt to income ratios, maybe a little slightly higher reserve requirement. We've already seen that over the last 9 months, but there are constant risk adjustment factors that are being made behind the scenes to make sure the lending industry is making good loans, which at the end of the day, okay, it tightens credit. It might make it a little harder for certain people to apply, but it makes the lending industry more sound. It makes there are not cracks in the lending industry like you saw 05, 06, 07 leading up to the crash in 08.
That's what they're trying to avoid, right? By doing all this stuff and I guess in that's what, the little adjustments and trying to not have it be where, essentially in the financial crisis, and there's a lot that we could unpack there to get into that we just don't have time to do today, but essentially lending dried up.
Yeah.
Like that, and that was the big, what I said earlier, right? Supply demand, there was all sorts of issues in the financial crisis, all of those things, supply demand was out of whack the other way, and then the money supply was just completely went away, and so that made it even worse because, even if you wanted to buy something, you couldn't. So that's a big part of that as well, right? So how do you feel about the market moving forward? Are you buying?
We are.
You just bought.
We just bought. We've been in the middle of renovations.
Airbnb, right? Some house hacking, long-term rental, lots of stuff going on. So
we took action. We're stabilizing assets right now, whether that means we're refinancing later in the year as rates come back down, and or potentially buying. I love short-term rentals and being able to do cost segregation studies and take advantage of some of the tax benefits that come with that. We're not actively looking right this moment right now because we are stabilizing our buys. You have different phases, right? Yep, absolutely. Awesome. Well, we'll make sure. If anybody's listened to this podcast in the past, they already have your information, hopefully. But we'll make sure that everybody has it. You lend in a lot of different markets. You're very active on bigger pockets in their forums. So make sure you reach out and connect with Grant. He's awesome at helping you figure out your strategy and think a couple steps ahead and make sure you're not backing yourself into a corner and looking at all your different loan options. And not just, giving you a loan, not just, hey, here's a loan that works for you. Anybody can do that, but the guidance side of it to help put you in the right loan for what you're trying to do is super anyone
important.
Can be an order taker and quote interest rates where things are at that day. Right now, it takes more time, but it's worth it to set the client up for success. We're doing reviews of people's tax returns, their drafts before they file, letting them know, hey, here's what your qualifying income looks like. Because if someone is in growth mode with their portfolio and they're wanting to buy multiple properties this year, or at least buy another property this year, that tax return, whether you're self-employed or you own other rental properties, that return, how it's filed, makes or breaks your qualifying income.
Absolutely.
And we can certainly strike a balance between being tax advantaged and loan income advantaged for underwriting, because there are certain things we can add back, but a lot of the clients we're doing that long-term planning strategy with, it's much better for me to look at a draft and give them input than have me looking in the rearview mirror once it's already filed.
Yep. And to that point, all of your team, that's what your team is there for. You can call up Rocket Mortgage or whatever, and they'll give you a rate and they'll sell you a loan. That's no problem, right? Or you can you can go to H&R Block and have your, hand them your box of receipts and say, here, input it in there, or TurboTax or whatever. But I had my CPA on a few weeks ago, and all of that stuff, you got to think abundance, and you got to think these people are on your side to help you get the most out of your investment. And yeah, my CPA might be a little bit more than going to H&R Block. In fact, I can guarantee that he is. But he's saving me money. He's making me money, right? And that's what your team should be doing for you. Is you're not searching for the cheapest. You're searching for the best, and you're searching for the ones that are going to advise you, and not just, you can call any agent and they can write an offer for you. That's fine. I can do that. Somebody else can do that. But who's going to help you, advise you, and help you sit down, and here's your resources, and what's your strategy, and what's your ultimate outcome that you're looking for, and let's come up with a plan and work with the other team members and figure out a way to make that happen. So
Exactly.
awesome. Well, thanks for being here again, Grant. Always a pleasure. And man, I think we'll be back here in about a month or so, just getting another update. So we'll see how things go over the next few weeks, but I'm sure it'll be interesting.
Sounds like a plan. Thanks for having me, Ben.
Awesome. Thanks again.